Hello everyone, welcome to This Week in the Markets. Information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regard to your objectives, financial situation and needs. Welcome to another round of market updates. Today we cover developments in Europe, US, Fed antics, commodities and the US dollar. In Europe, UK manufacturing production came in at 1.1%, above the expected 0.4%, further leaving behind all thoughts of a triple-dip recession. The British economy also grew by 0.3% in Q1 2013. The data provides some confidence of less bad times as opposed to full throttle recovery. The Bank of England has also maintained its asset purchase facility at £376 billion and left its official bank rate at 0.5%. The pound dollar has been gradually trending upwards with higher lows from 1.49 to 1.52 and now a short-term top at 1.578. Now this top also represents a 50% Fibonacci retracement of the December 2012 bearish trend. It will be interesting to see where the pair tests its support levels and where it consolidates. In the US, unemployment claims have come in at 323,000, below the expected 333,000. The average over the past month fell to the lowest level since before the last recession. And in earnings data, 71% of the companies in the S&P 500 have beaten profit projections, while 52% have missed sales estimates. Fed Chairman Ben Bernanke spoke in Chicago over the weekend, highlighting various topics such as current economic environment and the path for monetary policy going forward. Given the S&P 500's reliance on Fed monetary easing, one would only need to keep an eye on monetary supply figures to know when the law of diminishing returns will start to kick in. Now the world knows that the bank plans to buy $85 billion worth of bonds every month, but a more important figure, the amount of money entering circulation is falling, and that too rapidly. This is a function of institutions parking excess liquidity with the Fed rather than lending or investing that money. Now since December, the proportion of excess reserves to total monetary base has gone up from 55% to 59% in April. Now what this means is proportionally, more new money is being stored at the Fed rather than being circulated every month. Furthermore, total borrowing from excess reserves has dropped like a rock. Now the money isn't moving anywhere, and the Kiwi drug is clearly wearing off. In commodities, copper has seemingly formed a short-term top resistance at 3.38 after recording negative ground in the last few sessions. The base metal may go on to test short-term support at 3.24 with recent lows sitting in between 3.10 and 3.14. On a weekly chart, the 20-day MA has crossed below the 50-day MA, signaling a bearish trend, while this week's candlestick looks like it could be in the process of rebounding from the 3.39 EMA 14 resistance level. On top of that, both the 20 and 50 period MA have crossed the 200 period MA, which is the infamous death cross bearish signal. The US dollar index has broken through short-term resistance at 83.22 and 83.42. The index formed support just above 79 during late 2012 and early 2013, and since then has formed a higher low at 81.65. A break above the July 2012 top will build bullish momentum in the index. The bullish trend from the 79 level is further underlined by the golden cross. The current upward trending nature of the index would reflect an appreciating value of the dollar and would be a signal to decrease in inflationary pressures. This is also shown through the downward trending US break-even yields. That brings us to the end of this week's presentation. On behalf of Trading Pursuits, would like to wish you profitable trading.